This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
Sound on in April of 142!
Warren Buffett.
Carl Icahn.
John Templeton.
Buy low, sell high. Fear, that's the other guy's problem.
Dan Druckenmiller.
George Soros.
Paul T. Jones.
Peter Lynch. You wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
My guest for this episode is Mark Yusko. I invited Mark to come on the show for a couple reasons. First, I'm a huge fan of Mark's quarterly letters. He is a student of investing like few I've ever come across, and each letter he writes is just jam-packed with insight. But the second reason I invited Mark to come on was because he recently made waves in saying that he felt we were headed for a stock market crash. And not just a little one, like he calls the 1987 crash, but a real stock market crash. So in this conversation, Mark fleshes out this idea and lays out the parallels between today's market and that of 1929. We also discuss Mark's experience running the endowment portfolios at Notre Dame and the University of North Carolina, in addition to the time he spent with Julian Robertson setting up a fund of hedge funds to take advantage of the talent that Julian identified at Tiger Management. As I mentioned up front, Mark is just a wonderful thinker and a wealth of knowledge. So I really hope you enjoy my conversation with Mark Yusko. ¿Cómo estás, amigo?
Hey, doing well. Thank you for having me, Jesse. Great to be with you.
I appreciate you coming and doing this. You are somebody who I feel like a kindred, investment spirit in some sense. I read a lot of what you write, and it always seems to resonate with me. So I think probably this whole podcast, I'm going to be subject to some major confirmation bias, but it'll be a lot of fun in the process.
No, I totally agree with you, and I feel the same way. When I discovered you on Twitter, I found myself drawn more and more to your blog posts and your tweets. And, I have this line that if two people always have the same opinion, one is unnecessary. So I don't think we always have the same opinion, but we'll try to be necessary today.
All right. And I'll try and be the unnecessary one and let you do the talking. I just interviewed Raoul Pal, and he makes an interesting point about he thinks when you start in the business, the environment that you come into, market environment, really has kind of a formational effect on your investment philosophy and et cetera. I mean, could you tell me about when you started in the industry and what the environment was like and maybe how that was formative in your investment process?
Look, Raul's a good friend, and I could not agree more that is the case. Look, we're all human animals, and we are impacted by the environment in which we act, particularly in our younger days when we're more impressionable and we don't have any experience to compare to. So, the short answer is I started my career in investments, the month before 1987. So you could say, I'm a victim of that, so to speak, but not really in the sense that I didn't know enough to know. And also I was on the bond side. I actually went to school to be an architect. That lasted one semester. I switched over to engineering. That lasted 3 semesters. And then I decided what I really wanted to do instead of what Dad wanted me to do, which was I thought I wanted to be a doctor. And I spent, the rest of my time at Notre Dame studying science and biology and chemistry. And senior year decided not to go to medical school, went to business school instead right out of undergrad, which I actually don't recommend to people, but it worked for me because I needed some accounting and finance and investments. But when I came out in 87 into the work world, what I now in hindsight realize, because you don't realize it at the time, but I realize in hindsight is I really think science training is some of the very best training for investing, because investing really is about hypothesis formation, data gathering, hypothesis testing, reevaluation, reformulation. But I kind of grew up from a series of what I call happy accidents. I went to work for an insurance company out of school, The guy who was doing investments retired, so I took over the bond portfolio. I hired Dan Fuss before he was famous as an external fixed income manager. We ran the rest of the portfolio internally. Then I went to work for an equity firm run by some professors at Northwestern. And here's where Raul's exactly right. And the formation happens is, so I work with these guys who are deep value investors. I mean, Bill Breen invented low price to book investing. Gene Fama did not. He turned it upside down, called it book to market, won a Nobel Prize for it. So, Bill's pretty pissed about that. But Bill was the first guy to come out, and he was using the VAX computer. This was pre-PCs. Hate to date myself, but I came into the work world before there were PCs. In fact, one of my most prized possessions that I unfortunately lost when I left the first firm is I had bought one of the very first PCs from Michael Dell in his dorm room, what was called PCs Limited at University of Texas.
Wow.
But it's kind of fun, right?
Yeah.
Should have kept that. But so I went to work for this guy, and he was using the VAX computer at Northwestern after hours to do low price to book screening. So the original factor-based investing, long before anybody knew what value investing had been around, but low price to book quant investing wasn't. They raised $1 billion back when $1 billion was a real number, back in the late 80s. And, there were 5 of us. And I probably would have stayed there forever, learning how to be a value investor, a quant investor. But I got the call. And I don't know if you're a big sports fan, but I grew up, college football fan. I actually grew up a Husky fan. I know you're in Oregon, but I was a Husky fan, not a Duck fan. But I lost my train of thought because I went down a rabbit hole, Jesse.
That's fine. You got the call.
Oh, no, I got the call from Notre Dame because when Lou Holtz was the coach at Minnesota, he had a lifetime contract unless Notre Dame called. And I kind of had the same thing. I was working with these guys. We had $1 billion under management. There were 5 of us. The 2 old guys kept most of the money, but the younger guys eventually would get some of it. But I wanted to go back to my alma mater. So I went back to Notre Dame, and I worked in the endowment business. And again, back to this formation is I thought everything investing was about picking stocks and bonds. And I was just wrong. Most of investing, really, in terms of the success, comes from asset allocation. Comes from where do you invest, stocks, bonds, real estate, commodities, hard assets. How do you invest, hedge, unhedged, long biased, short biased. Where do you invest in Japan, in Europe, in the U.S.? And these big asset allocation decisions really drive everything. So I spent 5 years at Notre Dame learning the endowment model and how asset allocation really worked. And then I got the big break to come down and be the CIO at UNC. I was the number 2 guy at Notre Dame, always going to be the number 2 guy. The number 1 guy's still there. He's a great guy. Done a great job. But I got to come to North Carolina. And the great thing about coming to North Carolina, again, back to the environment, is if you go to an environment where everything works well, you don't learn as much, right? Because everything kind of works and you kind of just fit into one role and you're a cog in a machine and everything's great. When you come to a place that's completely busted, I mean, North Carolina's portfolio was totally busted. They were stocks, bonds, and cash. They were trying to time the market with a volunteer board. They had terrible performance. And they asked me to come in, by myself and build a team and take them so they could compete with Duke every year. Not in basketball and football, but in investing. And so you learn so much more when you're doing it by yourself. And so I reached out to a lot of mentors, Jack Meyer at Harvard and David Swenson at Yale and people I respected in the business, Harry Turner out of Stanford. And I picked up bits and pieces and I integrated those into our process at UNC and really took that value bias. So I am totally biased. I'm a value guy deep in my soul that comes from those formative years. Back to your question that I probably should have just given you a short answer, but I don't do short very well.
No, this is great. And I think, the margin of safety concept either immediately appeals to you or doesn't. And, I'm the same way. So I totally get it.
Well, and that's really important. I wrote about this recently. I write these overly long quarterly letters. People yell at me, especially my wife. But I like them because it's how I think. I mean, I sit down for a couple weekends, a quarter, and I write these things. And what I do is I take a great investor. And so I've done one on Soros, I've done one on Robertson, I've done one on A.W. Jones, but I did this one on Seth Klarman at Baupost called The Value of Value. And I really dug into this idea of margin of safety and value investing. And to one of his points, it is a genetic thing. It either appeals to you or it doesn't, right? You can either buy Tesla at the ridiculously silly valuation that it is today, or you can't, right? You just physically can't do it because it's so incredibly overvalued. So if value and margin of safety matter to you, you're constantly buying when you're being ridiculed because everyone else is selling. And then you're selling just as everybody is starting to buy and the party's just getting started. So you're that terrible, boring guy who shows up at the party to help the host, set up, and then you're leaving early to go to bed because you're tired, when everyone else is just getting drunk.
Right. It's no fun. You're always on the outside looking in at the party. And, it's interesting to me. I'm the same way. I always have been. And for me, I look at guy. I mean, there are actually guys, and I'm sure you know a few of them who can do both, who are good at margin of safety, but can also ride trends and play momentum. And that's
so true.
I mean, it's so difficult to do both. I mean, I think when you are a margin of safety value guy, that your biggest challenge is trying to ride the trend.
No, look, I am trying to get better, and I actually am better today than I used to be 10 years ago, 13, 14 years ago because I stayed at North Carolina for 7 years, 98 to 2004, and then I formed Morgan Creek in 2004. So we just had today, interestingly, is our 13-year anniversary.
Hey, wow.
Kind of cool.
Congrats.
Thank you. And I didn't realize that today is the day. So, I was very lucky. When I was leaving North Carolina, I had gotten to know Julian Robertson, the big cat at Tiger, because we had a lot of money with him, and he's a Carolina grad, and we had some great experiences. But when I decided to leave North Carolina, I got an email saying, "Say it ain't so," like Shoeless Joe Jackson, Julian. And I joke, it's not a joke actually, I don't get a lot of emails from billionaires. In fact, at that time, that was my first one. And so I said, all right, I'll go see Julian. And so I got on a plane, I went to New York, and I really thought I was going to get back to Oregon, I thought I was going to get my Nike shoe deal. Right? The coach at North Carolina or Notre Dame or any place else doesn't make a lot of money from the school. They make money from their Nike shoe deal and TV and all this other stuff. And I thought Julian was going to say, look, Mark, I know we don't pay you enough, but hey, we can work out something and get you some money to keep you around. And instead, I walked in his office. He came up, he put his arm around me and said, I'm surprised you lasted this long. I like you. I want to work together. I'm like, I'll hit that bid. So he helped us form Morgan Creek. He put in some seed capital for a while. He owned a piece of us. And then when his son graduated from business school and wanted to come into the business, we did a swap, and I kind of gave him the Tiger name back, and he gave me my equity back so that his son could run the fund of funds business inside Tiger. But Julian's been a friend and mentor for all these years, and Julian is one of these rare people who, deep at his core, he's a value guy, but I've had the good fortune in my career to put money with just about every amazing hedge fund manager that's come out of Julian's shop. We were first money into firms like Maverick and Tiger Global and Lone Pine and others over the years. And so I've met all these guys, gotten to know them, and I keep these notebooks of interviews that I've done with them over the years. And I probably talked to 30 plus guys. And I asked them all the same question. I said, what made Julian such a great investor? Because I think he's actually the greatest identifier, trainer, backer of talent our business has ever seen. But I asked him, what made him such a great investor? Because he actually has one of the greatest track records also. And without fail, they all talk about he had an uncanny ability to double up. He never doubled down. right? He would cut his losses, live to fight another day. But when he was running, he would double up into the trend. So few people can do that well. And I said, I'm trying to get better at it, but I think it's what differentiates the great investors from good investors.
Interesting. Well, and you make two great points. First of all, Julian's one of my heroes, and I think that's the first thing I read of yours was your annual report where you wrote about your experience.
Oh, my letter on Julian. Yeah. I mean, the big cats.
A couple years ago.
Yeah, it was all about the big cat's a bear. Oh my.
And not only was he, a phenomenal investor, and one of the reasons why he was a hero of mine is long short equity. It's just right up my alley. It's value based, but you make an awesome point because one of the big challenges of a value investor is getting sucked into a value trap. You see a lot of value investors double down on losers, and so to be able to have a value discipline but avoid that clear trap, which is is critical to success.
So critical. Well, it's interesting. It's you and I kind of met through Twitter, and Twitter's really interesting because it's populated by both fundamental investors, like myself, and day traders, like lots of other smart people I've met. And it's that ability to combine some of the great characteristics of trading, which is cut your losers and let your winners run, with fundamental investing, which is, no, wait, Seth says, hey, or Warren Buffett says, hey, if I bought something at 10 and it goes to 5, I need to buy more. Well, sometimes that's true, and sometimes it's not. And it all depends on, did you do the analysis right? Was your margin of safety high enough? And did the world not change? Because sometimes the world changes, and things that appear to be value become value trappy, as you said. You said more eloquently than I. But I think that's a really, really fundamental difference, again, between the great investors and good investors. There are lots of good investors. There are a lot of good traders. There are very few greats.
Yeah. Well, and that from that adding that kind of trading perspective to a value approach, I think it was Paul Tudor Jones maybe in one of the Market Wizards books says when something goes against you, it's always best to get out, and at least you can get a clear head. You're not subject to confirmation bias and all that kind of stuff. And if you want to get back in based on your reevaluation of all the merits of the investment idea, then you can get back in. But getting out allows you to have a clear head.
Which is so true. And look, Steinhardt talked about this. Another one of my big heroes in the business. In fact, I'm overdue to write a letter on him about him. But he talked about. He would walk in on a Monday morning and say, all right, team, I sold everything. I sent the portfolio to Goldman. They bought it all. So we have cash. So all your ideas, they're gone. So start over. And he just said sometimes you get in a funk and things aren't going your way. And when you're really smart or you have really, really smart people around you, you think you're right. And so you've done all this work on this company, and yet the market is telling you that you're wrong, and you just double down on your emotion and your conviction, and you ride these things into, big time losers. And that's what blows up people's portfolios, is they think they're right, the market's right, and they ride these losing positions down too far. And there's lots of different aphorisms about it, but Peter Lynch had a great one, which is, the problem with most investors is they do the opposite of what you should do. What you should do is pick your weeds and let your flowers grow. But most people pick their flowers because they're so afraid of losing the gain that they have, and they water their weeds because they're so sure that they're right. And you got to do the opposite. You got to pick your weeds and let your flowers grow.
Yeah, and it goes against, your human nature to do that. But that's one of the first things you learn. And you're getting at, I think, one of the greatest challenges of being a value investor, which is balancing, confidence in your own abilities to, analyze an investment opportunity and and understand or believe that you're right when the markets may be going the other way, but also balance that with the humility of understanding that there are always things going on that you're not going to be fully aware of, and there's always a possibility you're wrong. And balancing that confidence with humility is just such an art, and it's so incredibly difficult.
Oh, no, look, I mean, you just hit on my favorite word, and again, I know they're my Twitter haters who probably won't listen to this podcast, so it doesn't matter, who hate that I do this thing, #edge. And, I talk about keywords or key characteristics that give people edge. And the number one is humility, right? People who don't have humility, I don't think can be successful pretty much at anything, particularly not at investing. You have to have the humility to acknowledge that you could be wrong, that you will be wrong. In fact, if you're a legend, right? If you're Julian or George, or which is you're a legend when you're recognized by a single name, and you're only right 58% of the time. So even those guys are wrong 42. So I would say I aspire to get to 50, but it's Druck, which probably came from Soros, but Druck gets credit for it. It's not whether you're right or wrong. It's how much money you make when you're right and how much money you lose when you're wrong. So all of these things come into that, as you rightly point out, this discipline, which is exactly what it is. It's a discipline of being a value investor. And I think the big problem for most people who try to fake it, so to speak, is they'll justify in their mind why Amazon is a value play because it's trading at 168 times and it used to be at 1,000 times.
Right.
It's not a value. It's not a value. I use the example of, I said, well, it's cheaper than it was. I'm like, yeah, that's like getting pulled over for drunk driving and saying, well, officer, I'm not as drunk as the guys in the back seat. Someone had to drive. I'm like, no. And that's my big thing about the overall market today is people say, oh, it's not as expensive as it was in 2000. Yeah, whatever. So, but back to this value thing, the really important thing about value is the discipline to buy things with a margin of safety and sell them when they get back to fair value, and not mess around with, well, it's only 10% above fair value or 20% above fair value or 40% above fair value. And it used to be 300% of fair value. It doesn't matter. Fair value is fair value. And at some point, assets go back to fair value or below. And you got to have that discipline.
Yeah, and then all the way along that, relative value to whatever, fair value is, or market price relative to fair value, the risk-reward equation is constantly changing. And being aware of that. The other point you make about Julian is that not only was he a great investor, he saw he was a great investor in talent.
Oh. The best.
And so it sounds like you were kind of involved in that process with when he was seeding these funds. Is that right?
Yeah, exactly. I mean, look, my most of my career, I have been an allocator of capital, a seeder of managers, a fund of funds manager, CIO. That's most of what I've done. So over the past couple of years, I've been shifting more and more toward direct management. So kind of back to my original roots of picking securities rather than picking talent. We still pick talent, and we still have hybrid funds where we allocate money to managers, and then we run a center book, kind of the way Soros used to do it, and Julian for that matter. In fact, there's this great thing. Julian was on TV maybe a year and a half ago, and this very nice young woman got the chance to interview him, and she was all excited. You could tell, you could see her in her face. She was all excited. She says, Mr. Robertson, I've always wanted to ask you, what do you look for in a stock? And he says, well, we've had some fine young men come through our shop over the years, and I kind of look at what they own, and I buy some of that. And her face just fell. And she was like, oh, that's it? He says,
right.
Yeah. And that's not what he used to do, but today that's what he does, because what he did for so many years is he had this process and it included testing. They put people through 4 tests: an intelligence test, a collaboration test, a couple other secret tests. And you had to take these tests, and if you scored highly on the test, then you'd be eligible to work at Tiger. And then he would train these people, and then he would back them as they went out on their own. And you know, it's interesting. Part of it is the ability to identify talent, and he did it the way I think, you know, Notre Dame football used to be when we were successful back in the 60s, 70s, and 80s, which is they didn't go for the highest talent. You know, Julian didn't recruit from Harvard Business School and Wharton Business School and Stanford Business School. He recruited from Keenan Flagler Business School and McIntyre in Virginia and North Carolina. So he looked for people who didn't go to the top tier, but that had done something exemplary in their life. And then when he met them, they had passion, and his biggest thing was that they were competitive. He loved tennis players and golfers and people who were the captains of their sports teams. And for him, competition is what this game is all about. So he looked for super competitive people who maybe didn't have all the IQ points that some other people had, but they worked harder and they had more heart. And that's what I think separates the really great, again, the great investors. They're not the towering intellectuals that sit in the ivory tower. Now, it doesn't mean that there aren't very, very, very smart people like, you know, Jim Simons at Renaissance and others who are rocket scientists and have figured out how to use that. But the people that I really admire in this business, most of them tend to be not valedictorians of their class, but have a competitiveness and a humility about themselves and a congeniality. The other thing, well, congeniality, but also a personal integrity. I mean, Julian was a man of unbelievable integrity. And he would say, never fudge the numbers. Like if you started to BS him in a meeting, he would say, stop, come back tomorrow. Go do the work and come back tomorrow. Never fudge the numbers. Just don't make it up. And so, you know, he was an identifier of talent. I did that for a long time in my career. And I think it made me a better investor by trafficking with and hanging out with, you know, really, really good investors. You know, one of my favorite lines is, think of the 4 people you spend the most time with. That's who you'll become.
Right. And I think that's just so valuable, what you just discussed, because I get questions all the time, and you probably do too, from younger people who want to get into the industry. Yeah. And, you know, and I think you just laid out exactly what, you know, if you want to go work for somebody like Julian, you just laid out exactly what those people should be focusing on. So
well, it's that, and also, and you said it earlier too, is you said the Market Wizards book, it's mentorship. And what people haven't figured out, I don't think, enough, is that mentorship doesn't have to be one-to-one. Right? John Wooden writes about this in his book, Coach, right? That you can have a mentor through a book. Right? Pick up a Market Wizards book and read about these people. Read about Julian Robertson. Read about Michael Steinhardt. Read about, you know, Paul Tudor Jones. Read about these guys. That's a form of mentorship. And study them and watch them and look what they say on TV and look what they write and get Warren Buffett's letters. Although I don't really think Warren Buffett's a great stock picker. I know that's heresy. I just think he's a genius for buying low volatility assets and levering them up with negative cost of capital leverage. He is a genius, don't get me wrong, but this whole folksy thing about being a great stock picker, I don't buy it. You know, Seth Klarman, great stock picker. Julian Robertson, great stock picker. Michael Steinhardt, great stock picker. Paul Tudor Jones, great trend picker.
Oh, yeah. And so aside from, I mean, the Market Wizards books are some of my favorites I reread, and they're just underlined probably half of the words in there underlined. What are some of your other favorite books? Because I know just reading your letters that you do a huge amount of reading. So I mean, what are some of your favorite investment books? Yeah,
you know, you are astute, and I do like to read about the business. In fact, I don't read enough for pleasure, as my wife reminds me all the time. But I read so much for the business. My favorite thing to read, actually, are manager letters. I mean, I absolutely love them. So I love reading Hugh Sloan's letters from London, on particularly on Japan and Asia. I love reading Jeremy Grantham. Absolutely love it. I love reading. There's lots of managers out there that write great letters. Second thing I love is a couple of people who do paid services. Now, they're expensive, but they're worth it. And Raoul's one. You just had him on. He's fantastic at GMI. But my favorite guy, actually, and I don't want Raoul to hear this, but so I shouldn't play favorites, but actually he is my favorite. But my favorite guy to read, and I can't miss it, is Kirill Sokolov at 13D. I mean, he would be a fantastic podcast. I mean, Kirill he's an amazing guy. I mean, he's a seer. I mean, he literally sees around corners. He wrote a book in 1982 called Inflation's Ending, Are You Ready? When everyone else thought inflation was going to stay in the teens. I mean, the guy is just incredible. It's a great story. I mean, he's personal friends with the Dalai Lama. He had adult onset deafness. He got the first cochlear implant. I mean, I love the guy. And he writes a thing called What I Learned This Week every week. And that is an amazing thing to read. But in terms of books, probably my favorite investment book of all time, the only way you can get it is through a used bookstore online, is called The Dow Jones Averages. And Dow is TAO. And it was written by this guy, Bennett Goodspeed. And it basically is a discussion of the melding of investment theory and Chinese philosophy. And it basically talks about how most people aren't ever going to be great investors because they only use half their brain. They only use the analytical side, the left side of their brain. And you need to be a whole-brained investor. You need to channel the creative side, the right side of your brain, the left-handed side of you, or the more feminine side of you if you're a guy, and vice versa. Girls need to use both sides, female and male. But the preface of the book says, dedicated to those with the guts to trust their gut. And there's all this research about how we have more nerve endings in our stomach than we do in our brain and all this stuff. Gut instinct is real. And women's intuition is real. I mean, women outperform men. It's a whole other conversation for another day, but it's one of the points Bennett makes, and there's lots of research. Terry O'Dean at UCLA has lots of research about it. But people who trust their instinct, and that the instinct, Steinhardt said, is that supercomputer in your brain that's working all the time, even when you're not paying attention. And if you can channel that, and whether it's through meditation or any form of quiet time and solitude and getting away. I mean, living in Bend, Oregon, living in Chapel Hill, Sir John Templeton, I wrote about him. He moved to the Bahamas. Getting out of the group think is really important. Quickly, another book I love is The Great Boom Ahead by Harry Dent. People rail on Harry because some of his other stuff, later books, were not as accurate. But The Great Boom Ahead, written in 93, 94, is uncanny. I mean, he predicted the global financial crisis in 2008. In 1994, he predicted that the iPhone would be the primary method of connecting to the World Wide Web. Who even knew what the World Wide Web was in 1994? Because it hadn't really been invented yet. Or actually been popularized, been invented, but hadn't been popularized. So right. That book is amazing in understanding S-curves and how demographics is destiny. And I tweet about this all the time. The killer Ds, demographics, debt, and deflation, that guides everything in investing. And if you get on the wrong side of those headwinds, it's tough to make money.
Well, that is a perfect segue into what I'd like to talk about next. But the book recommendations are fantastic. I have not read either of those, and Dow Jones Averages sounds like it's right up my alley.
Oh yeah, you'll love it. No, you will love it. It's fantastic.
Yeah. And that was actually something before we get to this next topic. Based on what sounds like the premise of that book is, I like to play music. For me, that's getting away from the markets, but it's still, it's exercising a different part of my brain and whatnot. And I make all types of musical analogies to the markets and stuff, just probably more than anybody wants to hear about. But what for you? I mean, it was interesting for me to hear about you studying, or initially want to be an architect, engineering, studying science, pre-med. I mean, one of the ideas of this podcast is the greatest investors that I've studied bring in a lot of other disciplines. It's that art of worldly wisdom that Charlie Munger talked about. What for you are some of it could be hobby, it can be another discipline of science. What for you is kind of one of those areas outside of finance that's had a big impact on your financial evolution, I guess?
Well, no, look, it's a great point. In fact, another one of my favorite books is Investing: The Last Liberal Art. Exactly to your point. And I do think that worldly wisdom is important, and it explains why you're such a great investor. The fact that you got this musical background and you're using both sides of your brain. You've got the creative side going with the analytical side. One of the things that has actually helped me, and I'm going to be in your neck of the woods, one state over in a couple weeks, up in Idaho, going fly fishing. Is I love fly fishing. I love the time on the water. It's a form of meditation, the rhythmic back and forth of the casting. But also fishing is a very great analogy. In fact, I used to write all my letters about fly fishing and investing. In fact, I should probably put them all together and write a book about it. That if you think about the art of fly fishing and the process of fly fishing, it's so similar to investing. The water temperature can change from day to day and can move, but the fish have a traditional pattern that you're trying to outwit. You got to match the hatch, so you got to have the right process for the right time that goes to value versus growth versus momentum. So there's all these things that go to. So I agree with you that bringing in lots of disciplines, and one of my big things is balance equals edge, that you have to be balanced in your life, right? Between family, between friends, between time away from the office, time in the office. And I think sometimes the harder you work, the less effective you are to a point. And so
Absolutely. Yeah.
Spending time away, and I'm a huge fan of this concept of solitude, right? Now, I don't take it to as extreme as Raul does, where I moved to Little Cayman, and there's 140 people on the island. Now he's actually back in Grand Cayman. But, being away from the masses and taking time where you're not reading anyone else's opinions, you're not reading anyone else's idea, you're not totally plugged in Twitter, although I am probably overly immersed in Twitter, as my wife would remind me. But sometimes just taking a break, and I went camping over 4th of July with my little guy who's 6, and for 3 days in the North Carolina mountains, we didn't have cell phone access. I didn't know there were still places on Earth that didn't have cell phone access, but we didn't have it. So I was totally off the grid for 3 days, and it was amazing. And so now I'm going to have to do that more often. I mean, just be totally off the grid. And I think that replenishing and cleansing, and I'll leave you with one last thing here, which is not what you asked me, but I think it's interesting. Because I have older kids, 28 and 26, and then my wife and I had a lull, and then we had another baby unexpectedly at late in life, at 48 and 47, and which has been fantastic, and he's amazing, and it's amazing for us. But in that first year, I had more big ideas, big investing ideas, profitable ideas. I had more big ideas in that first year than I probably had in the previous 10. And I look back on it like, why did that happen? Well, what was happening is I'd go home at 6 o'clock, and my wife would literally hand me the child and say, I'm out, I need a break. And she'd leave for a couple hours and do what she had to do. And 3-month-old, 6-month-old, they don't do very much. They kind of sit there, and we'd sit on the floor together, and 2 hours would pass. And I felt like I wasn't doing anything, but my brain was working the whole time. And I'd have these aha moments. And that, I think, is something that all of us need more of in our life, is that time to have those aha moments.
Yeah, well, you were shocked out of your routine, and forced to think of things, do things differently, do different things, and think of things in different ways. And so that's just great for the creative process.
Yep.
Very, very cool. You mentioned demographics, debt, these other things. And speaking of books, I just finished reading Rainbow's End, The Crash of 1929. So
awesome.
You were at the Malden Conference recently, keynote speaker, I believe.
Yeah.
And you gave a quote that's gone viral.
Yeah.
Yeah. You said, "I'm telling you right now, the U.S. is going to have a massive crash."
Yeah.
What are you thinking about in regards to this stuff?
So let's actually let's get it back to totally being in the proper frame.
Okay.
You're right. I mean, you're right. But it like everything, people hear certain things and they write certain things, but they're not. It's not 100% right. The intent is right. And what I said was I was paraphrasing Roger Babson. So my last two letters actually were about Roger Babson and Ben Graham. And 2 letters ago, I wrote about Roger Babson. Roger Babson, for people who don't know, was the guy who called the crash in 1929. On September 15th, 1929, he said, "I'm telling you again, the same as I told you last year and the year before, there's going to be a crash, and it could be okay, remember the word he used. It like spectacular, but it's not spectacular. Terrific. He said, and it could be terrific. So I was at this speech, and I was saying, look, people didn't believe Babson in 29 because he said it in 27, and the market went up. And then he said it again in 28, and the market went up. And so by 29, they're like, you're an idiot, you're wrong, the market's never going to go down again. Well, not only did it go down, and actually 2 weeks after he said it, Irving Fisher made the famous quote about the markets have reached a permanently higher plateau. They could never go down again. Well, not only did they go down, they went 86% down, and they went way below where they were in 1927. So Babson was right, and what I was saying was, look, a year ago, I said that I thought there could be a recession and that the market was due for a correction. And I was saying it again, that here I am a year later saying the same thing. And look, I believe Newton's third law is right. For every action, there's an equal and opposite reaction. Babson spent his whole life obsessed with this idea of Newton and gravity and trying to reverse the effect of gravity, which he was never able to do. And the reality is gravity rules. And ultimately, there will be a reaction. And I believe that we are at the second high. I mean, these are just facts, right? We're at the second highest valuation in history. The S&P is the second highest valuation in history. Earnings of the S&P are the same as they were in 2012. Yet we're up almost 100%, only because the multiple has nearly doubled, the PE ratio. So we're paying more for a dollar of earnings. And people justify that because interest rates are low. Well, are they going to stay low forever? We'll see. But my biggest issue is that just like in 1929, but what I wrote about, and my thesis is, if you look at 1928, when Herbert Hoover was elected, okay, he was the second president elected with no experience after William Henry Taft, which didn't work out so well. We had a Republican sweep. You had this roaring 20s, penultimate kind of bubble run-up. And from November of 28 till September 3rd, 29, the market went up 40% and peaked at this level that no one thought could ever go down, and everyone thought it could only go up. Well, that was the highest value it had ever been in history, and it crashed. And here we are today at the second highest valuation, because the 2000 peak actually was worse than 29, and so now we're second to the 2000 peak. And if you look, since Trump was elected, he was our third president elected with no experience. If you look what's happened, we had a Republican sweep. We promised all these things, the same things we promised in 29. We promised to export Mexicans. We promised to cut taxes. We promised to decrease regulation. None of those things, actually, they did export 500,000 Mexicans, but none of the other things actually happened. They actually ended up raising taxes. They actually ended up increasing regulation. And a small slowdown recession in 29 turned into, ultimately, the Great Depression over the course of the 30s. And the biggest change was Smoot-Hawley, which was, putting up tariffs and trying to go into a trade war, which we hear rhetoric about all the time. So I just think there are too many similarities to 1929, and I think politically there's a lot of similarities, economically there's a lot of similarities, but most of all demographically it's exactly the same. And this goes back to the Fourth Turning book, which is another good book, and Neil Howe, who was also at the Malden Conference, talking about this generation and the demographics of this generation is exactly like the generation in the late 20s in terms of the number of people that are turning 65 and the dearth of young people between kind of 25 and 45. So, I think it's one man's thesis, and we'll see. I only got a couple months left to see it play out, but.
Yeah. Well, there are some fascinating parallels, and you have also said that you just feel like, you talked about gut instinct. You feel in your gut, that we're potentially heading for kind of a Hooverville type of experience. And when I was reading the Rainbow's End, they talk about to take advantage of the late 20s. Rise in the markets, there were all kinds of investment trusts created. In fact, they created so many trusts. There are more trusts than stocks in the market. Yep. And, you just look at, there's more ETFs, or there's more indexes than stocks in the market today. And it's just,
there is nothing new in this world, Jesse. That is such an important point, and no one's talking about it. And the key is the investment trusts were exactly the same thing as ETFs and index funds today. Exactly. And then on top of it, they were levered. And that's exactly what's happening in the market today in two places. One, you've got personal leverage with margin debt at now the all-time record high. And we know that ultimately margin debt peaks at the top of the market. That makes sense. People buy what they wish they would have bought. That's what they do. But the thing that actually is also happening, which happened back in 29, is the corporations are borrowing at record levels. And so the combination, and actually I did the math on this, is if you look at the last 5 years of money borrowed by corporate America, it's equivalent to the same amount that was borrowed in these investment trust leverage schemes in the 5-year period from 25 to 29, inflation adjusted. Exactly the same, $2.4 trillion. It's truly amazing.
And that's something that I was trying to kind of quantify in reading the book, because, they were talking about margin loans essentially getting to about, and I measure margin debt compared to GDP. And so I think GDP back then was, $100 billion or something. And they got up to almost $7 billion in margin loans. So almost 7% of GDP. I think we've gotten close to maybe 3% in just pure margin debt. But you're right. When you look at the leverage corporations are using to buy equities, you probably get to this a very similar number.
And it's all the buyback stuff, right? What they did is it's financial engineering to enrich the management teams. They call it shareholder value maximization, SVM, which is the biggest scam, the second biggest scam ever perpetuated against investment kind. The first was the Tax Act of '86, which had nothing to do with taxes. It had to do with transitioning from defined benefit plans to defined contribution plans, so corporations could save a third on their pension liabilities and transfer all the risk to the individuals, which is such a scam and no one talks about it. That's a topic for another conversation. But, look, we're at a very tenuous spot, and, that gut instinct, and I'm old enough to have lived through a couple cycles, back to Raul's original point, that, you are certainly a product of your environment that you're brought up in the business. But 87 wasn't a crash, right? It was a crash with a rebound. And we went on and made new highs for the next 4 years until we had the recession in 91. So it wasn't the same as, 99 or 29 to 33. And it certainly wasn't the same as 2000 to 2002. So people say, oh, you're just biased because you came in during the crash. I'm like, no, I came in during the flash crash. I mean, that was portfolio insurance, although I could make an argument that ETFs have an element of portfolio insurance to them too. This low vol. To me, that's the biggest risk in the market is these low vol ETFs because they only buy stock based on the volatility of the price. Well, as soon as that volatility goes up for any reason, and it could be, retirees being forced to sell because they turn 70 and a half. It could be because, growth slows. It could be because someone gets a margin call. But as soon as volatility rises, those same ETFs must sell. They can't think. They're not allowed to think. So I call them dumb, right? They're rule-based. I think there's a lot of systemic risk.
Yeah, and those low vol ETFs are interesting because they're based on whatever it is, 3-year beta or 5-year beta, and so there's really no market action that they're just a whole ton of stocks in there. There are emerging markets ETFs that have lower beta than the S&P 500 right now, which is kind of silly. And so you're absolutely right. But you bring up another structural concern that I have, which is not just the low volatility, low beta. It's the short volatility positions out there, and not just the short volatility positions, but all the volatility targeting that's overlaid on top of short vol. So you have risk parity is probably the most popular form of that, and that's been, I know that's really difficult to kind of quantify how that works, but even aside from that, there are a lot of insurance companies and whatnot that essentially, scale their equity exposure based on realized volatility. And so there's just so much to me in that structural side of the market too that creates risk that we've never seen before. That's concerning as well. So, and
that's really the more appropriate comparison to portfolio insurance is this short VIX and this put selling. It's been sold as free money. You've got pension funds doing it. Have no business risking their capital that way. People think it's riskless. It's far from riskless. When you have something like VXX, 97% of its shares are sold short, that ends badly. There's no way that doesn't end badly. Now, I can't tell you when. It's like the CAPE ratio, right? I can tell you mathematical certainty that 10 years from now we're going to look back and say, geez, it was stupid to buy stocks at a CAPE of, high 20s. We're definitely going to say that 10 years from now. But I don't know if we're going to say that 10 months from now or 10 days from now. But I know we're going to say it in 10 years. And the same thing's true of these volatility structures is they will crack. And when they crack, they will unwind in a hurry. And that's one of my favorite hashtags is hashtag risk happens fast. When this reaction finally occurs, the action of the volatility skew, the ETF and indexation, and the move to passive, even though it's not passive, another topic for another day. It's cleverly disguised active. Then you got the risk parity. You got the smart beta, which doesn't exist. It's an oxymoron. Beta is dumb by definition. Alpha is smart. So you got all these things, and they've led to a misallocation of capital. They've led to a complacency and a reduction in a perception of risk. And what we know, right, from economic theory is that the absence of something, Hyman Minsky, ultimately creates its presence. So the longer we go without a recession, the worse the recession is going to be. The longer we go without a reversion of the mean and volatility, the worse that reversion is going to be. The longer we go with leveraging up corporations, the worse the deleveraging is going to be. So you've started to see people like Ray Dalio, start to say, yeah, maybe I shouldn't be so quite. And then actually, I'm out. So he's left this, giant house of cards that he's put together with this risk parity strategy. And I have a friend who calls it risk disparity that's about to happen. So I think there's a lot of risk out there.
Well, it's funny. There was an article a few months ago. I took a screenshot of the chart that Bloomberg did, and it was about risk parity and how it can potentially contribute to volatility. And on the chart, they misspelled risk parity as risk party. And so I thought that's perfect. These guys are taking advantage of the risk party. But you know what happens when the risk party ends?
Oh, the hangover, baby.
Yeah.
It's funny. I got in an argument with somebody the other day on Twitter on this that, why do you think there has to be a hangover after the party? I'm like, because there is. There always is. I mean, you can't get rid of the business cycle. You can't get rid of risk. Risk is like energy. You can change its form, but you can't create or destroy it, right? Heat energy can become light energy. You can't take risk away. You can move it around. You can take single stock risk and make it portfolio risk, or you can take currency risk and make it derivative risk. But you can't get rid of risk. And the Fed has not abolished the business cycle. Companies are going to go bankrupt. I don't know when, but they're going to. This debt has to be paid back at the corporate level. Now, the government debt and all this talk about the central banks and the treasuries doing a debt jubilee. Yeah, if you get to 100%, as looks like the Bank of Japan might get there, you might have a shot at doing that. But if they only own 50% of the bonds and you cancel 50%, well, what happens to the other 50%? So there's all this talk about how we can just magically make it go away and the central banks can just print new money. Look, if it were as simple as printing money to create wealth, wouldn't every country in the world be doing that every day?
A lot of them seem to be trying.
Well, they are trying, and that's why there's so much.
Yeah, the difference between what you and I believe and what maybe central banks believe and what a lot of investors believe today is that the Fed has not banished the business cycle. They've pulled demand forward from the future, which means there's less economic demand going forward. But they've also, and that's kind of a common thing that I think a lot of people do believe, and maybe in understanding secular stagnation is, when you pull demand forward for years and years and years, you're left with not a lot of demand. And
right.
But also by the same token, I think Chris Cole has talked about this is. You suppress volatility today. You don't banish volatility. You're just pushing that volatility into the future. And so, like you said, the longer that this goes on, the more volatility is being pushed in the future. The more extreme that volatility is going to be when it finally gets here. So
it's axiomatic. It's just math. That's another one of my hashtags. Just math, and it's just it can't not be right. It's one of those things where, my all-time favorite line of all lines in investing from Sir John Templeton, the four most dangerous words in investing. It's different this time. It's never different this time. There's nothing new in this world. Every story you can go back to, hundreds of years ago or thousands of years ago. Every, quote from all the leadership gurus comes from people like Socrates and Seneca the Younger. So there's just nothing new in this world. I mean, human beings are pretty simple animals, and they do the same things over and over again, and they expect different results. And, that just doesn't work out that well.
Well, and I think you started this conversation by talking about, physics and Newton. And, when you push something so far in one direction, it's got to come back. It's just the way the physics works, and it works in the markets as well.
Yep. Every action has an equal and opposite reaction.
Absolutely.
That is fact. That is law, right? It's called the Newton's third law. It's not called Newton's third good idea or Newton's third, thought. It's a law. And
we think these are ideas when they come to the markets, right? They're not laws, but in fact they are.
Everybody believes they're smarter and that they'll get out first, right? They'll get out before everybody else, and they can stay at the party right until the cops come. They won't get arrested. Look, I wish them all well, but I sleep. Someone asked me in an interview a number of years ago, what keeps you up at night? I said, I actually sleep really, really well. I said, well, how can that be? There's all this risk and all these things. Like, yeah, but I don't expose myself to those risks, and I don't lever myself up into those risks. And so my return stream historically is kind of boring, day to day, month to month, year to year. But over the long term, compound better because you avoid the downside. And I'll leave with this one funny story that was talking to someone who was an investor in one of our funds a number of years ago in 2011. I remember 2011 was a choppy year; the market was flat, and he says, I'm out. You just haven't made any money. I said, what are you talking about? We're flat this year, but we were up 9%. We were up 9% last year and up 15% the year before. And he says, yeah, but last year the market was up 15, and the year before that was up 26. And I said, right, but what about the year before that? He says, well, yeah, fine. The market was down 35, and you were only down 20. I said, well, let's just do the math together, right? Down 20. Up 15, up 9, flat. I got 99 cents. Down 35, up 26, up 15, flat. Okay, you kicked my ass the last 2 years, but you got 94 cents. I said, 99 is better than 94. He says, no, it's not. And I said, okay, I'll bite. Why not? He says, well, you didn't make the 2008 adjustment. I said, what's the 2008 adjustment? He says, well, I don't count 2008 because that was an anomaly and that'll never happen again. I'm like, holy crap. Okay, take all your money, go far away, and lose it in the comfort of your own home. Because if you believe that bad things never happen, and when they do, they don't count, then yeah, my style, this value style, is just not going to be for you. So.
Well, that's interesting. I think it was Jeff Gunlack recently said, as soon as you hear somebody say never, it's about to happen. Yeah, so
absolutely.
Never is one of those words to pay attention to.
Absolutely.
Hey, Mark, thank you so much for taking the time to do this. I've really enjoyed the conversation. Where can people keep up with you and your thoughts?
Yeah, so a couple things. And one, this was so much fun. I haven't enjoyed a conversation like this in a very long time. So thanks for having me on and for being such a great host and moderator. Great questions. Couple things. One, you can follow me on Twitter at Mark Yusko, MarkYusko. We've got a website, which is morgancreekcap.com, and that's got downloads of all of our manager letter or my quarterly letters and media appearances. And then I'm out and about on TV every now and then, otherwise. Feel free to reach out and find me through email as well. Although I'm not very good at email. I'm much better at Twitter.
Yeah. Well, this has been a blast, and I encourage everybody to check out Mark's letters. They are long, but they're worth your time. I get something out of each one of those. So thank you very much, Mark. I've really enjoyed this and appreciate it.
All right. Thanks, Jesse. I look forward to doing it again sometime.
And that does it for another episode of Super Investors in the Art of Worldly Wisdom. Mark and I covered a ton of ground in this episode, and he gave a bunch of wonderful recommendations in terms of reading material. So there are a ton of links, notes, charts, videos, etc. at thefelderreport.com related to our conversation. In fact, for every episode, I put up a blog post at thefelderreport.com with all of this types of material supporting the conversation that we just had. So, as always, I want to thank you all for listening. And until next time, buy low, sell high.
Looking good, Billy Ray. Feeling good, Lewis.
Man looks in the abyss. There's nothing staring back at him. At that moment, a man finds his character. And that is what keeps him out of the abyss.